What's up everyone, it's Scotty with Money Investing. In this video, we are going to be talking about real estate investment trusts, or in other words, REITs. I've been getting a lot of questions on these. So we'll be talking about what REITs actually do during interest rate rising environments when interest rates are going up. How do they perform? How have they historically performed? And I'm also going to go over a handful of some of my favorite REITs, which I'm also planning to add more of in my dividend/real estate investment trust portfolio as well. So I hope you guys enjoy this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. I will be dropping the swing trading ideas video over this long weekend. And of course, you'll get access to all the other binds alerts, options alerts, trade ideas. And don't forget, we've got that Easter sale going on for the fundamental and technical analysis courses. The bundle currently is 60% off. So you can take advantage of that, and the coupon code is going to be Easter. If you've ever wanted to learn how to perform a comprehensive fundamental and technical analysis on any company or stock of your choice, this is the course for you, with over 60 plus, or actually 80 plus lectures and over 30 plus hours of content available. And the coupon code is going to be Easter, and there's going to be new content added on a more regular basis. So links are going to be down below if you're interested in joining. So this is actually a video that I did about 10 months ago, talking about real estate investment trust and how they have actually been a very good performer. According to historical standards, they've actually performed really well, even though interest rates are rising. Now, theoretically, when interest rates do go up, on a more theoretical basis, REITs don't tend to perform well because of two things. Number one, as interest rates go up, the REIT's cost of capital goes up as well. Why? Because it's going to cost them more money to basically borrow and buy properties, right? That's obviously number one. As interest rates also go up, that puts even more pressure on their tenants, which could potentially lead to higher vacancy rates or lower occupancy rates. So there are a couple of reasons that I wanted to mention. And the third reason is, as interest rates go up, as the 10-year yield goes up, the risk-free rate, which is the 10-year yield, becomes a lot more attractive relative to the dividend yield offered by the REIT. So those are three reasons on a more theoretical basis as to why REITs don't necessarily perform well when interest rates are going higher. However, on a more practical basis, REITs have still performed much better as interest rates have gone up. So as you'll notice that historically, REITs have performed well during periods of raising long-term interest rates, with average 4-quarter return in periods with rising interest rates of 16.5% compared to 10.68% in non-rising rate periods from the first quarter of 1992 to the fourth quarter of 2021. Additionally, the REITs have also outperformed the S&P 500 in half of those periods. In other words, 50% of the times when the treasury yield was rising, and the positive association in that has historically been observed between periods of rising interest rates and REIT returns is consistent with an improvement in the underlying fundamentals. Now, another thing to notice here is that the market interest rates typically increase during periods when macroeconomic conditions are strengthening, and the same strengthening that can often drive positive REIT investment performance as well. However, the only difference between historical measures and right now is that the Federal Reserve is raising interest rates into a weakening economy, right? It's not a macroeconomic condition which is strengthening, but instead quite the contrary. We are seeing the Federal Reserve raise interest rates into a weakening economy, as all the indicators have suggested. So that is a little bit of a difference there. However, strengthening macroeconomic conditions typically lead to higher occupancy rates and stronger rent growth, increased funds from operations and net operating income, rising property values, and higher dividend payments to investors. All those things are true. However, as I mentioned, this is all based on this idea that this is going to, in other words, that the Federal Reserve is raising interest rates as the economy is strengthening. That is not the case. We're raising interest rates right now in a weakening economy, and I've already done a separate video going over how commercial real estate might actually be under a lot of stress. Now, that doesn't necessarily mean that all real estate investment trusts are bad. That doesn't mean that all REITs are going to be terrible in a rising interest rate environment. And that's exactly the point of this video. I want to make that distinction between what to stay away from and what to actually look for when you are looking at REITs. Because just because interest rates are going up, and this is not happening in a strengthening macroeconomic condition, but instead we are weakening right now, and that means lower occupancy rates, that means lower rents, lower values, and lower net income, net operating income, lower funds from operations. That doesn't mean that all REITs are bad. That's the distinction that we have to make. This right here is the REIT's total return from 1992 to 2021 fourth quarter, as we have seen the change in the 10-year treasury. So you can see that even if interest rates have gone up, 85% of the times the returns are positive as yields have gone up, and 50% of the times have actually exceeded that return of the S&P 500. So in terms of 2023, in 2023, the U.S. economy will continue to be marked by mixed economic growth results, waning job gains. By the way, there is a very, very cool website over here that's called NAREIT. So in other words, NAREIT, or the ticker or the actual URL is going to be REIT.com. You can pretty much go and just immerse yourself with a lot of information, a lot of data with respect to real estate investment trusts. They've got, different guides and different FAQs, different reports and documents and different things if you want to really analyze what REITs are going to look like, or what REITs are all about, and find out different REITs that are publicly traded, all that stuff. But Bloomberg Consensus Forecast Survey placed the odds of a U.S. recession within the next 12 months at 62.5%. So the likelihood of a U.S. recession is pretty high, as I've already mentioned before. There's a lot of indicators that are suggesting that we are going to see a recession later this year or early next year. And why property fundamentals generally remain solid at the end of 2022, there has been some evidence of softening going into 2023. The industrial, retail, and apartment property types maintained elevated occupancy rates that were higher than their respective pre-pandemic levels. Now, here's the key takeaway. Office occupancy continues on its downward trajectory, dropping nearly 3% from its 2019 average. Here's the distinction that I want to make, is that we have to really make that differentiation between office versus retail. And I am very much going to be focusing on retail REITs, not office REITs. Because what we have learned from the pandemic and right now in the commercial real estate market as well, a lot of them are office loans, office mortgages, commercial loans, in other words, to fund office properties, office REITs. They are in trouble because of all the work from home, lower occupancy rates, very, very high vacancy rates, thereby lowering funds from operations and lowering net operating income. And as rates have gone up, that has also caused a bigger problem for that type of market. However, when it comes to retail, industrial, and more government properties, more telecommunications, more utility properties, that is still strong, in my opinion, paying very, very hefty dividends considering how much the prices have started to pull back. I'll go over some example in this video, but you'll notice that this right here is going to be the REIT's return before, during, and after a U.S. recession. So even during and after a recession, REITs tend to actually outperform the Russell 1000 index. That's the comparison that they're making. And you'll notice almost a 16% return and over 22.7% return in the next 4 quarters after a recession. This right here is also going over 2023 numbers, where you'll notice that REITs have historically low leverage. And what this is telling us is on the left axis is the debt to market assets, and on the right axis is the weighted average time to maturity. So what you'll notice is that the debt to market assets have stayed below 40% since 2011 and stabilized in the low mid 30%. And right now, once again, we're starting to push back up. However, we are still a lot lower than compared to where we were back in 2009, or even historically from back in 2020. This right here is going to be how they have structured the debt. Now, this is not true for all REITs out there. There are some that are focused on commercial real estate and office spaces, and they are definitely underwater. But what you'll notice is on the left axis is telling us the share fixed rate debt, and on the right is the weighted average interest rate that's been fixed. And as interest rates were lower, they were able to lock in those rates. A lot of these REITs were able to lock in lower rates because they were lower, right? Back 2 years ago. Think about yourself, right? If you pretty much bought a home 2 years ago, you were able to lock in a mortgage at 2%, 1.5%. That's exactly what REITs also did, and they're locked in at that rate. And the percentage of REITs, or in other words, companies that own real estate have been able to do that, has increased substantially to over, it looks like 85 to close to 90%. So there's a lot of REITs out there that have locked in at really low rates, and they don't mature up until, I think, the term for the debt was just over 59 months, almost 5 years in 2005, and rose to its peak in 2021 of 89 months, almost 7.5 years of that fixed term structured debt. Now, I want to go over some, stocks, obviously, and in other words, REITs. And my favorite one, obviously, the Realty Income Corporation, ticker symbol O. I've actually owned this one for quite some time, and I'm actually planning to add a lot more of Realty Income Corp because they pay out monthly dividends. They are a dividend aristocrat, and their dividend yield right now is sitting at almost 5%. 4%. And you also get some capital appreciation over time. Again, this is not a short-term trade or anything like that. If you take a look at the monthly chart, I mean, historically, it's just done really well since 1995. It has gone up over 5,000%. That's only for the price itself, not to mention every single month they've paid out dividends to shareholders, and they've been able to consistently increase dividends as well. And the more important thing is to focus on their portfolio, right? What do they actually own? As I mentioned earlier in the video, stay away from office commercial real estate, right? Office spaces are pretty much a done deal. And I'll go over specific places where office real estate is still valid. But for the most part, Realty Income Corp, you'll notice grocery stores, convenience stores, dollar stores, restaurants, drug stores, home improvement. Again, restaurants, we got health and fitness, gyms, all that stuff. So what do they actually own? Dollar General, Walgreens, 7-Eleven. FedEx, LA Fitness, we've got BJ's, B&Q, CVS Pharmacy, Lifetime Fitness, Red Lobster, we got Tesco, Kroger, Home Depot, like all these places that are going to be there for a long, long time, right? Their physical stores need to be there so that people can actually go there and buy the goods and services that they need. This is the top 7 regions. So Texas, UK, California, Illinois, Florida, Ohio, Massachusetts. And again, retail is majority of their portfolio, right? 81.9%, with gaming being only 2.9%, industrial 13.3%. So retail industrials is where the focus needs to be. And other, which might include office space, is only about 1.9%. So as you can see, that other includes 27 properties classified as agriculture, which is actually even good, consisting of approximately 272,000 leasable square feet of property available. Another one to really consider is Ventus. Ventus is also another one, but more specifically focused on health and sciences. So you'll notice that they actually own 811 senior housing communities, medical office buildings, life sciences, R&D. Then we got health systems, skilled nursing facilities, and international hospitals as well. So high-performing real estate portfolio, approximately 1,200 properties. And again, they're very much focused on these types of things, real estate wise, more on the health and medical sciences, which there is going to be need for, right? These are not things that can be done that can be done remotely, or work from home risk is not really there. So occupancies are going to be very high. Public storage is another one that I've actually done a video on in the past, and we all know public storage, and their dividend yield is actually good too. So if you come over to PSA, you'll notice that they have consistently gone up on the monthly chart. Again, beautiful chart, just been going higher from back in 1999. The stock's up a little bit over 3,000%, and the yield is almost 4% for this REIT. And again, it's a storage business, very, very simple business model where people pretty much rent out the space to store their stuff, and all they do is pay public storage, and public storage in return pays a very high dividend to the investors. Another one to focus on, and this is more on the government side, it's Easterly Government Properties. This has been selling off quite a bit right now, but if you take a look at the properties that they own in the US, they're all government facilities, right? They're all backed by the US government. So if you take a look at some properties in California, this is going to be Chico. California is, again, a square foot Department of Veterans Affairs, so VA outpatient clinic in Chico, California. This right here is going to be DEA, that's your Drug Enforcement Administration Office. This right here is going to be FEMA. So again, I think it has to do a little bit of financial, emergency response preparedness in the United States. Again, if you come over to, let's say, Utah, this property over here, FBI, we've got that. And this one has an incredibly high yield. I mean, this is, last time I checked, it was like a little bit over. DEA is the actual ticker symbol. It's been selling off quite aggressively. So it is down from $22 down to $13, so down 42%. It's not been doing super well since 2020. So I'm definitely going to be doing more research on this, but the dividend yield is almost as high as 8% for this REIT. And you can see the consistently growing revenues and earnings as well. And they actually rent out to government properties here. So those are some things that I'm really focusing on in terms of my REIT/dividend portfolio, staying away from office spaces, staying away from commercial real estate. And if in commercial, I'm mostly looking at retail, industrial, medical, health sciences, utilities. Another one that I forgot to mention was AMT, that's American Towers. And you'll notice that American Tower is a leading independent owner, operator, and developer of multi-tenant communications and real estate, and nearly 98% of our revenue is generated from leasing our properties, as well as fiber, a highly interconnected footprint of the U.S. data center facilities and other urban telecommunication assets in some of our international markets to our customers. So again, AMT is another one that has a pretty decent yield, consistently moving higher, for many decades. And you'll notice the yield right now on this is a little bit under 3%. So let me know your thoughts on REITs. Again, not all REITs are bad, and just because interest rates are going higher doesn't mean that they're going to perform poorly, because in the past, as you can see historically, there's been some REITs that have done really well, and these are the ones that I'm going to be really focusing on, kind of doubling down and kind of building out that real estate portfolio at some point where my yield to cost increases to, let's say, 15-20%. Where at that point, you're not really doing anything except just making 15-20% every single year. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.